Thank you, Heather, and good morning, everybody. It is a pleasure to be here speaking to you from the slightly later time zone in Auckland, New Zealand, as Heather said. And also, with that background that Heather read out, you should know that I live, or should I say, I work in a large office building in central Auckland that is full of buffaloes and alligators and the occasional cute little bird. And it is a lovely environment. It is, as Chris said, an ecosystem, but I just happen to have the good fortune to work in a building full of exactly those sorts of people. So we have a lot of interactions amongst the ecosystem, and we love talking to companies. I will share a slide deck right now, which is quite short and to the point. So I guess to take the analogy, and at the risk of straining Chris's analogy, because Chris and Mark are the right speakers to cover those two areas of fundraising and private equity, even though I have a venture capital background, I'm here today to talk about a particular other aspect of future investment growth capital. And that is dealing with large corporates. Now, large corporates are actually, in the analogy terms, they're more like a river than a swamp. The large corporates are parties that are interested to get new products into their pipelines, as they call them. They're interested to find companies that are breaking new ground and doing exciting things, companies that are beginning to take market share from them. They are very interested to deal with and engage with such parties. So in the sense that people in this room are in that field, I really am here today to just talk about the dealings with global corporates. They are a real fixture in our ecosystem, and so don't forget, even if you are excited by your own product and you're dealing with it every day and your worldview is around that product and what it can do, sitting around you in the marketplace for my consumer dollar is the Haleons, the Kenneviews, the Sanofis of the world, the Bayers, the Reckitt's, the Procter & Gamble's. That little eagle down the bottom is Taisho, one of the big Japanese consumer products companies, and Starter is a German one. But all of these brand names are large companies. They all fill the front of your pharmacy shelves. Some of them fill the back of your pharmacy shelves as well in the pharmaceutical world. But they also fill the health aisle of your supermarket with products which you are by and large competing with. And so the first obvious question is, I know about them, they're out there, why should I deal with them? Just before I get into that, it's a note really that everyone should be aware of that in that consumer products and particularly the natural health products arena, the big guys are going through their own rapid evolution. Haleon, a name that won't be known to everybody here, is the rebranded consumer health of what was GSK and Pfizer. So GSK Consumer Health and Pfizer Consumer Health merged a while ago, and they rebranded as Haleon. Kenneview, the next one down, is the rebranded Johnson & Johnson Consumer Health. Sanofi have just announced the segregation of their consumer health arm from their pharmaceutical arm, and no doubt it'll get a sexy new name pretty soon too. Bayer is a particular division in the larger Bayer that is on consumer health. It's different from their animal health, it's different from their pharmaceutical, etc. So they are going through a lot of changes. Not that that's germane to today's discussion, but it is worthy of note that you better upgrade, or should I say update your understanding of who's who in the zoo before you pick up that phone or make an approach, because they are changing relatively fast in big corporate terms. And now I get to the point of why would I want to engage with them? There is a whole range of reasons. And firstly, I should say it's not for everybody. So a lot of people listening in here, this may never be the path you want to go down. But for some of you, it is a path you not only want to go down, but you're almost bound to want to go down sometime. Why? Because these companies are competitors. No matter what your product is, these big guys will have an adjacent niche, if not central niche, in trying to meet the consumer's demand for your product or your company. So always they are a competitor in one sense or another. Competitor right up at that level of the consumer dollar, not necessarily a competitor for the particular target application or indication a new product might have, but they are always a competitor for the consumer dollar. And as we know, we should know, consumers are fickle and they are likely to drift from fad to fad. These guys are reading the market every day. Number two, because they are potential partners. And obviously, as I'll get into in the next slide, partnership with these big guys can entail them helping you to actually put your product on a very sexy space on a supermarket shelf, eye level, main aisle, or they can help you go into new markets, particularly new geographies, because all of these players are in all important international geographies. So if you have a very good looking company or product, but you want to see it one day attack the US market, attack the European market, get into the Middle East, North Africa, these are potential partners because they are already there. And the third one, because they are potential acquirers. If your company is doing well, if your products are taking market share, if your products are novel or in any way new and are appealing to that fickle consumer out there in numbers, then the big corporates will one day be interested to buy you. That may not be the future of everybody in this room, but if that is one of the futures, then you certainly ought to understand this segment, this river that runs beside the swamp. One of the things that is worthy of restating here, really updating you on, is that in the old days, many of these companies had big R&D divisions. They would be developing new products in labs, dusty labs in the back of London or wherever. They would be actually doing some pretty exciting new science all around the next best product or the next best iteration of their own products. That has changed. Increasingly, the big corporates are downsizing their R&D departments and increasing their M&A budgets. And I'm afraid there's a very obvious reason. The venturing world, the early stage startup part of our economy, is doing the work for them. The startups are taking the risk. They're risking other people's capital. They are trying to develop products and failing half the time. They are pushing into markets with new things in a very guerrilla way and a novel approach with social media or whatever to try and get market share. And what the big corporates are saying is, hang on, not only can't we invent all our own products, we shouldn't even try. We should actually be focused on exactly what we want to focus on, which is control of shelf space, control of brand value. And we should let the startups of the world invent products. And then when they work and when they're in our face or in our space, we can acquire them or partner with them. So very big shift over 20 years from the big R&D houses to now much reduced R&D houses and a lot of partnering going on. In that same evolution, the big corporates have developed what I call a multitude of doorways. So this is well worth knowing before you engage with corporates, how they think and structure themselves. So the big corporates will have whole divisions about licensing, in licensing they call it. So they will be looking around the world trying to find products that they could license in and sell themselves in their other markets or under their brand or through their channel as one of the new P&G products or one of the new Haleon products. So that in licensing is a whole division in these big corporates. Distribution, it's simple what it is. It says, okay, if you've got a good product and we like it, maybe we can tack it into our distribution chain. Less common because the big corporates are very jealous of protecting their brand and building their brand. So they don't like just distributing someone else's product, but sometimes they will. Equity investment, unfortunately, probably the smallest door, is that they will at times invest in young companies. They do that largely via a mechanism called corporate venture capital, which is a composite word, obviously. So the corporations themselves are now developing venture capital funds in their own name. So there will be a Pfizer venture capital arm. There will be a Haleon venture capital arm. These companies do behave like venture capitalists. So Mark's reference to them in the earlier presentation is spot on. They will have all sorts of stringencies around them. They will have high demands for return. They will have short time frames. They will be quite involved in the companies they invest in. But they do it, unlike mainstream venture capital, they do it largely with a corporate lens. So they will not be investing in the best new idea anywhere. They'll be investing in the best new idea that augments or improves the parent company. That is not always the case, but it is the majority of corporate venture funds are actually what I would call strategic venture investors, in that they are investing strategically based on the needs of their parent. The parent, by the way, provides the money, so that's obvious. So equity investment does happen. It is one of the smaller doorways, and it's got its own pros and cons, but it does happen, and you should be aware that some corporates will have headlines on their webpage about corporate venture investment. And the final one, the most common and oldest one of all really, is acquisition. So we really like you. We think it's a great product. We'll buy you. Can we offer to buy you? Can we do a deal? And so again, not for everybody, but if you are thinking one day to be acquired, then again, using Mark's terminology, a bigger fish down there could be what you're looking for. You want to grow your company to a certain size and then find a larger company that could benefit from bringing your company into it. I'll just finish that area of saying that this list is why corporate partnering is not for everybody. If you have a good product and you are making headway in your market or products, if your company is doing quite well, thank you very much, and returning profit, then you may never want to be acquired. And unless you have, again, using Mark's terminology, unless you have the sort of characteristics that appeal to globals, don't even bother trying to have that conversation. And those characteristics are that your product should be internationally potential. So it should be not just a New Zealand for New Zealand or an Australia for Australia product. It should actually be a product that could have legs in the big markets. You also probably want to be in the divestment or exit mindset. If you are running a company that is fine, making money, returning capital to you and other shareholders, then that's a fine life. Don't think you need to engage with the big corporates. If, on the other hand, some of these avenues that I listed, these doorways appeal to you, then it's worth you understanding how the big corporates work. The bottom line is that these big corporates have staff who have their activities as their whole raison d'etre. So there will be a head of licensing and a team of licensing executives in those corporates who are every day waking up and trying to figure out how to do license deals. That's quite different to you. You are doing a license deal every second year, if you're lucky, or one in your lifetime. But these guys are doing it all the time. And it's very important, I find, to demystify the big corporates, to remember that you're dealing with humans who have motivations and needs just like you. And that those humans, if you understand their needs and motivations, you can have a much more constructive and progressive conversation when you do go through these doors. So in finding these parties, these people, be aware that the terminology is quite varied and you will not find it in the same place on every corporate website, but they may call it the External Innovation Division. They may call it the Search and Evaluation Division. They may call it the Open Innovation Division. Reckitt had a very nice turn of phrase. They called it outside in innovation. I thought that was quite clever, outside innovation. Or they may have portals through which you can engage with the company online and say, I have an idea, I have a product, I have a thing that I want to partner with you. Please fill out the boxes and put it in there. I won't come back to this one, so I'll say it now. The portals are a hit and miss. No matter how much money and design and effort a big corporate's put into a portal, and it might look lovely on your screen, it is my experience that putting something in a portal, as in filling out the box, sending your idea, sending your product description, sending your company in through a portal, gets you about a 1 in 3 response. It's either a job that isn't popular in the corporates or it is just flooded and they have too many to answer. I just find that it is not a reliable way to go in through a corporate. We in our firm, who do a lot of corporate partnering, always find the individual with the right title in the company and have the personal conversation. So that way, at least you get to know straight away. You don't sit around waiting and you don't worry a little bit about who's reading your stuff. You know, that's the issue about portals. Now I go on to my last slide. If you've ticked the boxes on the previous slides and you're thinking, yep, I do see value for my product or my company or my range or my invention in the big world of corporates, then how do I become part of it? And a bit like both Mark and Chris have said, it is a sort of a special form of business development. So of course, on a daily basis, you're doing BD, finding new customers. In the idea of finding a corporate customer, there's just some, more than a few, nuances around how they think and work. And you need to understand those, and you need to understand your target. And if you've got 5 targets, you need to understand 5 times over what is their process and what are the human level factors that I need to navigate in even getting the right conversation. On the left-hand side of the screen, I've got the processes, and there are just some traps for young players in here. Again, the corporate world has its own rules and you should understand them. Confidentiality. In the corporate world, there is a strong allergy to risking their own intelligent, smart, patent-protected positions by receiving confidential information. Big corporates are highly allergic to receiving confidential information until and unless they've asked for it and or until they've signed confidentiality with you, signed an NDA with you. They always want to look at you first in a non-confidential lens. So be aware, do not do one of the things that pisses them off, and that is send them a deck with confidential written on the bottom as the first thing they open. Because the minute they open it, they're going to have kittens. They're going to say, wait, I didn't want confidential information. Now I've opened it. Oh, this is terrible. Just to explain, they are dealing with hundreds, if not thousands, of innovators and entrepreneurs. And all it takes is one nutter, I'm sorry to say that, but all it takes is one nutter to say, I had an idea and then I saw it on your shelf 2 years later, I'm going to sue you. And they've just created a world of pain that was unnecessary. Even if they had nothing to do with the new idea, that is why they are very finicky about protecting and formally recognizing when they receive confidential information or when they don't. And they never want it first. They always want non-conf information. So even going back to Mark's idea of the deck, or sorry, Chris's idea of the deck, of the fully formed perfect deck, always have a non-confidential version. That is your conversation starter. That is the way you get them in. The second process is not so much a process, is these big guys who have largely evolved out of big health companies, Haleon out of Pfizer, you saw the other ones there. They are very data hungry. They want good data on the efficacy of your product. They don't want you to tell them that you've got 3 anecdotes that work. They want some sort of a trial. They want some numbers. They want some measured benefits or effects. So again, don't even engage, or don't waste your time engaging too heavily if you haven't got that data. Spend any disposable money you have on improving that dossier so that your product or company looks like it is well supported with good data. And I'm talking there about, in the natural products world, of course, about evidence, empowered by evidence, I could say, couldn't I, Nigel, at this point? The third point there is complementarity with their portfolio. So you need to look at the Reckitt portfolio if you're dealing with them and understand how your product is both a competitor to some of them, or potentially a complement to some of them, or potentially a new niche that they need to get into. So don't go head to head unless you've got very good data and you can actually threaten them. If you are looking for a corporate partner, find one where, in my terminology, the door is already half open and they are overtly looking for something like your company or product, or whether they have a gap, or where they have a gap that your product could fill, or an existing product that your product could augment. Even, you have to get out of your egos here a bit. Even what is it that my product could look like under that product brand, under the Centrum brand? How does my invention or product augment that? How could it make it better? Fourth one there is, and fifth one go together. Their mindset will be around 2 things before they engage with you. How big can your product or company become in their hands? And how much time and cost is it going to take to get it there? So if you are early in the stage of development, if your dossier is about promising research findings or an interesting early market foray, they will be looking at you and saying, okay, there's a fair bit of time. I'm going to have to wait X years before I could possibly launch this in the USA, or I'm going to have to wait Y years if it's a very strong regulatory approved dossier that I could launch in the USA and Europe and somewhere else. So just be aware that they'll be doing that calculation in their head before they even take your call. They'll be saying, is this a product that's got scale? And is this a product that is within a certain time and cost from market? And remember that you're competing with 100 other ideas, so they're looking for the lowest cost and the shortest time. Now, my time up very quickly then, the human factors, and I just don't want you to forget about these. The drivers of the specialized staff are written into their KPIs, their bonus structures. They want to do deals. So you are providing that for them. They are overloaded. They have always got too many things. You want to be, and this is a third one's a silly one, but you want to be cognizant of the time zone they live in, the currency they think in, the language and the accent they use. Don't send them an invite in Australian time. Don't send them a proposal in Australian dollars. Always convert. And finally, they, like you, are driven personally for the need for impact. They want their life to actually make a difference. That's it, Heather. I will close on that point.